You can get access to all of the information you want pretty easily, and you might have AI come up with a solution, which it can do in our industry now.
Yeah.
People still want, well, maybe this generation and the next one, they still want confirmation that they're doing the right thing. So for us with AI, it's absolutely brilliant because where we add 90% of our value is that confirmation.
Today on the Smart Investor Show, I'm joined by someone who truly understands the numbers behind great financial decisions. Nick Reilly, the founder and managing director of Inovayt. Nick has been in the financial services space for over 2 decades and founded Inovayt back in 2007. Under his leadership, Inovayt has grown into one of Australia's most recognised independent financial advice groups, offering lending and financial planning solutions to individuals, investors and businesses. With a background in accounting and finance and qualifications across both mortgage broking and financial planning, Nick has built a reputation for strategic thinking, clear advice and helping people not only manage their money but grow it with purpose. He's also one of the hosts of the Numbers Game podcast, where he and his co-hosts break down finance and business topics in real, relatable way. Nick, welcome to Smart Investor Show.
Thank you, mate. Thanks for having me.
It's good to have you live. I know we've had a few discussions, so it's good to pick your brain in the studio. So a lot of people like to hear a little bit of thoughts around financial planning, mortgage broking, and just what you're seeing in the market as well.
Awesome. Stoked to be here and looking forward to sharing some wisdom, hopefully.
I'm sure. Mate, normally we start with just getting a little background on you.
Yep.
Give us a Nick Reilly story, schooling, growing up. I guess what got you to start your own agency 20 odd years ago?
So born in regional New South Wales, so in the Riverina.
Right.
The Riverina.
Yes, of course.
So lots of fruit trees up there. So I was there till age 18 and then moved to Melbourne to go to uni. And from there, never really left Melbourne. So
never went back?
Go back a lot.
Yeah.
Enjoy going back now that I'm a bit older, because I appreciate the stillness. But when I was younger, I didn't want to be there for obvious reasons.
Did you have property or just live in the city off?
Hobby farm. So my parents are still on, it's like 48 acres. Bit
nice
of a hobby
now
farm,
for the grandkids go there, I'm sure.
So it's nice to get back there now. Moved to Melbourne, studied accounting, banking and finance. I did a double degree, and
so you got a personality. I'm surprised you did accounting.
Well, I did it for about 2 months, and actually hated it. So I worked out quickly that accounting wasn't for me. But I did want to be an accountant because I like numbers. Mm-hmm. I was always thinking about money and how to make more of it. So accounting was of interest to me until I started the studies, and I only went to uni full time for maybe a year. I think, maybe not even. I didn't like uni. 12 hours of contact a week. Yeah. To be honest, most of the work I did remotely. You would log in, get all the notes, do your study, then go and do the exam. So
were you living on campus or did you
I was living
independent?
In a facility for uni students, but it was off campus. So you could say it was on campus, I guess. So it was 12 months at uni. Then I went and got a job in a mortgage broking business in administration. And within
that young.
Yeah. I would have been 21, I reckon. Yeah. 22. And then started selling mortgages at like the age of 23 with no idea. Trying to talk people into their biggest purchase of their life, and I had no life experience. And then from there that business unfortunately went under for reasons untoward to me. Like I was a bit disconnected from that. So 25, I didn't have a job and just decided to start doing it myself. And here we are sort of 20 years later. So 18 years later.
And I guess at that age you have no fear, right? There's nothing to lose because you didn't have anything.
Outside of myself. And went and got a credit card. Didn't max them out, I don't think. I might have maxed them out, but got as much limit as I could. And started a mortgage broking business. But it was an easy decision back then, whether you call it naivety or I really didn't have too much fear.
It's a different world, right? I mean, there wasn't social media now. Like in my industry, a lot of the big agencies are social media stars. They even call themselves content creators. Back then, you had to meet people, network, or were you able to, if that company went bust, were you able to bring some clients across to start with?
Exactly right. So not necessarily clients, but definitely referrers. So had some referral groups that were mainly real estate agents that I was working with.
Yep.
So they continued to refer me business, which helped. But to your point, it was all relationships back then. It was cold calling.
Yep.
Literally, walking down the street.
Long lunches.
Long lunches. But even just walking into real estate businesses off the street. That's what it was, you know. And mortgage broking was fairly young as an industry back then, so it wasn't as common.
I'm assuming the banks were still the high percentage of, whereas today it's flipped, right, on its head.
For sure. And you only really went to a mortgage broker if you had a problem. And when I first started, a lot of lenders didn't pay brokers. You had to charge a fee. So it was a very different world back then. It was all about line of credits. I remember Citibank were the first one to come out with a line of credit, load up your credit card, put all the money into your home loan. It was when all that stuff was happening, which is all just standard stuff now. But back then that was a product and you sold it. And, we had to charge a fee for that advice. So it was a good learning. It was good learning to go through. I look at mortgage broking now and I think, geez, it's so much easier than what it was back then.
Yeah. Compliance, was that still, obviously we've been through a few iterations of compliance in your industry with the Royal Commissions and things, but back then?
Nowhere near what it is now.
Right.
No, everything was faxed and paper-based, so nowhere near what it is now. There was no real, care's the wrong word, but all you had to really do was disclose what the client was receiving from an interest rate or a repayment point of view. That was probably the main thing. But nowadays, there's a lot you need to do just to make sure that the product satisfies the client's needs.
Yeah. So
did that. End up finishing uni part-time. Took me a long time, but I got it done. So I do have an accounting degree. Not that I'd ever do it, but and here we are.
But I'm sure it's very relevant to the numbers you're working on now in planning, wealth, and also finance.
Yeah. And I look back now, and it definitely, I'm definitely glad I did it. For anything else, like to be a financial planner now, you need a degree. So some new legislation came in. If I didn't have that degree, there would have been more study I had to do to be a financial planner, which some of our guys, including my business partner, have to do more study. Like he's been in the industry for 30 years, change of legislation, more study because his degree wasn't recognised. So I'm glad I did it in the end.
I'm assuming that would have had a large effect on the industry where people say, well, stuff it. I've been doing it for 30 years. I'm now 55. I'm not going to go back to uni
Pretty
or
much
study
half the
more.
numbers.
Yeah, half. Yeah.
And they're still diminishing because some of that legislation is still pushing through, or the cut-off dates are still pushing through.
Of course,
in financial planning, there's a increasing number of people that need help because the baby boomer population coming through to retirement, and a diminishing amount of advisors. So it's a good industry to be in at the moment. There's plenty of work if you are good at what you do.
Right.
Yeah.
Well, 20 years of doing a lot of good work.
Yeah.
Build a big business. You've obviously seen a few people fall over, or a few items fall over.
Yep.
What are some of the memorable ones? I'm sure we speak for hours on them, but what are a couple of the pitfalls that I guess you've seen, and also how can we get our listeners to avoid those?
Yeah. So business or people? Business?
People. Or either. Both things. Business are people as well, yeah.
Yeah, well, I kind of linked the both really. And we had a chat about this the other day, linking how would you treat a property portfolio where you treat it exactly like a business. So I guess some of the things that the key learning for me in business has been probably go with your gut. I don't think you should do that with property, but with business, go with your gut. Generally, when you know something, you know. So the things I've learned is to, fire people quickly because you generally know they're not right. And you've got to have a crack, and you've got to understand the risks of doing that. Make sure you've got the downside protected, and then have a crack from there. So they're probably the two biggest things I've learnt.
Were you always good at that?
Not really.
The big one, more about people, because it's a tough one to do. I know I struggle with it. It's
no, I think in the early days I was too nice, and I, optimism bias or whatever you want to call it. But when you hire someone, you've made a decision to hire them, so you believe in the hire. So I think I've been guilty in the past of definitely keeping people for too long. I think I know I have been.
Yeah.
But I think now with a business our size, you can't afford to do that. So you look at all the stakeholders in the business now, we can't afford to get those decisions wrong. So, we've got strict lead indicators that we expect to see when people come into our business. And if they don't, then we've just got to make a call, and it's for the benefit of everyone else in the business. Whereas when you're a smaller business, you can cover that stuff up a little bit.
What about from a client perspective?
Yep.
One of the things I see from my side, which you guys see before I do, is, making decisions on purchasing a property without getting finance.
Yeah.
Structures is an important one, which you guys would help a lot with, particularly with the accounting associates in your business.
Yeah.
What do you see there, the little pitfalls that people tend to rush without, building? We always talk about building the team of experts around you, right?
If we're going to silo in investment, because obviously with owner-occupied purchases, people buy where they need to buy and what they need for their family, whether it's type of house or zone. But with investments, it's been interesting being in the industry for so long and seeing the different trends that have occurred. And if I think back, even, as soon as, it was early as 6 years ago to 10 years ago, we used to work for some investment groups that would, or work with them that would, telemarket to people.
Yeah.
There's this amazing tax saving that you haven't been told that the ATO is released.
They're still doing that, by the way.
They're still doing
calls,
that.
Yeah.
And I've just seen a lot of people be sold to and make the wrong decision. And, I'm going to single out apartments and high-rise apartments that don't go anywhere, capital value-wise. Cash flows are no good. I've seen that trend, and I've seen that since evolve into the rise of, firstly, the rise of education, and our access to information obviously keeps going to new levels. So people have gotten smarter, and then people like yourself, BAs coming in or buyer's agents coming in that have a real education, will have an education in investment and have a client approach versus a property approach. So, you're recommending properties in other states. You're investing where it makes sense. You're not investing, or you're not selling properties to people that are on your books.
Or what we call holding stock. I often say to people when I'm talking, I don't have anything to sell you today.
Yeah.
We're here to talk about you. Property will come later. Let's just talk about you. Yeah.
Yeah. So it's definitely gotten better. The only thing that worries me now in this current environment is how easy it is now to access information and how easy it is to access the wrong information.
Yeah.
Social media, people building profiles and followings on social media, giving advice. Some of it's great, some of it's not, and some of it's great for some people, but not great for others. So that worries me a little bit.
It's been really hard for you especially when you use the word advice, which we all know cannot do.
Yeah, we can't.
But you're getting maybe younger people or whatever it might be, new entrants in mortgage broking. We see it a lot in buyers industry. Some of these individuals or companies call themselves content creators. Which means they never leave a studio that we're in now, but they're giving amazing content out there and their businesses absolutely skyrocket.
Yeah, but the problem is that content might not be right. And it's not saying it's not right, but it's not suited to individuals.
Yeah.
It's not one size fits all, as you know. So what might be right for one person is not right for the seconds. And the challenge I have as a financial planner is none of that stuff's regulated. So we can't do that.
And you've got all the regulations, the degree qualifications, yet someone can become, let's say, buyer's agents while we're talking about it, and over a weekend get a license in Canberra and then go and get mutual recognition across Australia.
Well, if anything, we're probably ones that should be able to do it.
Correct.
But we can't. So seeing that trend now does worry me a little bit. And to your point before, that telemarketing stuff on pitching the ATO's tax saving initiative, to think that stuff is still happening is crazy.
But we're going to see that go to the next level now with AI. So they can make, one person can make 100 calls a day, for example, in conversations. An AI bot's going to take that to 1,000, right? One bot. Because they can just dial all day and then do that conversation with you over the phone to maybe pre-screen you and then maybe take you into a
well, it's already, we had, it's funny you say that, and I won't mention names, but we had one of our guys in the office, mystery shopper, buyer's agent, a couple of months ago, and they were 100% convinced they weren't talking to him, that they were talking to a bot. So it's crazy. I played the same one.
It only caught me out at the end when I realised I wasn't paying that much attention for obvious reasons because I didn't need the service. But I thought it was a good exercise for me to, since they called and went through it all. And it wasn't the end when they said it was the usual cheesy salesmanship of, look, we're booked out for 2 weeks. Yep. But, Nick's diary's just opened up right now. I'm talking to you. Can I put you into Nick right? I can connect you right now.
Yep.
No, sorry, mate. Look, I just want to I've already got plenty of properties and I'm very aware of property investing. Thanks for calling anyway.
Yeah.
And obviously that's the first time someone said that because it's continual learning. So it said the same thing again.
Yeah.
I went, holy shit, you're a bot.
Yeah.
This is a really good call. And it actually surprised me how good the quality was.
Yep.
There was a lot of pauses, just that split second in between conversation.
Yep.
I did pick that up, but I didn't think it was otherwise the sound was very high quality.
Most people won't pick that up, right? Particularly if they're not looking for it.
Yes.
Included myself. Like if you're not looking for things, you don't pick them up. So, so it's going to be interesting to see where it all goes. But what is comforting is, businesses like yours and there's others, and people are now very much aware of what you guys do.
Yeah.
And very much aware of the value that you can add. And I think there's more of an awareness around property spruikers, let's call them, that are selling a stock list. I think there's been quite a bit in the media as to why that's not the best way to go. And most mortgage brokers or financial planners are educated now, so they can, we warn our clients, who you're talking to, what are they suggesting you buy. Yeah. So I think our industry's got better at advising clients what they shouldn't, or who they should and shouldn't be talking to.
And that's the tricky part with ASIC, we talk about collusion and a lot of these, let's call the word spruikers, are one-stop shops.
Yeah.
So the legal,
in-house,
the accounting, the finance, everything's in-house. So you cannot get independent advice.
That's right.
Impossible, right?
That's right.
So you think the legal guy is going to alert you to a couple of clauses. He won't do that because he won't get his salary that weekend. So that's the danger. Yeah.
And they're very hell-bent on keeping it all in-house.
Yeah.
So but it's so much better than it was, mate. And it's what's really pleasing now is to see clients that have got plans. They want to build a portfolio. They've got a strategy. They're in a couple of states. They've got a couple of different looking assets. So that's pleasing to see. Yeah.
Would that be one of the, think back 20 years ago, property investing, or like you said, when you started, a lot of clients who were coming to you is because they need you, because the banks weren't able to help them.
Yep.
And then obviously industry changed, your business grows.
Yep.
What have you seen really now, especially in the last, since the COVID boom with property investing? Has that changed in what you're seeing?
Yep.
The type of clients coming in, are people trying to get to 5, 10, 20? The other day someone was talking about 100 properties in their portfolio.
Yeah, we're seeing people, I go back to the education piece. People are coming to us and they want to build out a plan, and they're aware that it's not the best decision to buy in their own street. This is the kind of stuff we're seeing now. So they'll come to us and they'll say, we want to build a property portfolio. We're already attached to a buyer's agent or an investment expert, hypothetically, and they want to know how to do 2, 3, 4 purchases. So we're seeing a lot of that now, particularly with younger people.
That's great that they're coming to you for that, because especially if they're already attached to someone, where sometimes they may say, well, we'll build your plan for you.
Yeah. And I think it's, I just look at social media, right? And the access to information out there, and whether it's true or not, but, people that are on social media saying we've bought 4 or 5 properties. So people understand that there's an ability, they probably have the ability to do that if they want to with the right plan. So they're coming to us and they want to build out a strategy for number 2, for number 3. Whereas traditionally it was, I know I should buy an investment property because everyone else is doing it. If you challenge people on that, well, why are you doing it? Well, I'm not sure. I should. Well, why have you bought that house? Because it's close to mine.
Yeah, mum and dad said, we're good area, son. We grew up here. Yeah.
What are you actually trying to achieve here? Oh, we're not sure. We just think we should be investing. So there's now an awareness.
And that's probably where, you would have, how many of your clients would have probably invested in Docklands over the last decade? I get them all the time. South Bank in Brisbane, same issue.
Yep.
Had one client, 4 apartments, had them for over 10 years.
Yep.
They just thought, here we go. They've all doubled.
Yep.
We're going to Julian, take equity out of all of them and roll again. They were in their 50s.
Yeah.
I said, no worries, I'll do all the valuations for you. I have to ring. They said, just email me. I said, no, I want to speak to you.
Yeah.
I was on Zoom. And I said, no, I really do want to talk to you.
Yeah.
So I spoke to them, then I emailed it to them, and they started tearing up because their 4 properties were worth less 10 years later.
Yep.
So that whole strategy we're going to do, we couldn't do it. In fact, the strategy now is they're selling them one by one.
Yeah. Very common. And we obviously have a financial planning business, as we mentioned. So probably where we offer, I think, the most value, or the demographic we offer the most value to, is pre-retirees. So people in their mid-50s, probably got 10 years of work left, want to know what they can do in the next 10 years to really set themselves up to retire. So many clients have self-managed super funds with a underperforming property that they bought through a property group a long time ago. And we spend a lot of our time convincing them to sell because cash flow is no good. Body corporate's gone up, value's gone nowhere. And we actually can't build a strategy out for them with an asset like that, not knowing what it's actually going to do for them. And then we talk about the opportunity costs. Well, if it's 10 grand or 10,000 a year negative, what's the opportunity cost of that 10,000 being invested somewhere else? So if you're not getting the upside from a capital growth point of view, you need to get rid of it ASAP. So we do a lot of that, and also unwinding SMSFs, because people bought purely for the reason to buy a property, bought the wrong asset. So if they sell that asset, they no longer need a SMSF. So they've spent the money over the years setting up the super fund.
The audit fees and everything, yeah.
3,000 to 4,000 a year generally to get financials done and audits and ASIC fees, all this stuff. So
you unwind them and they go back to industry funds?
For sure.
Yeah, right.
Or just a normal
that was the only reason they did it,
fund.
Because they just want to diversify. If that was
100%. Yeah, and again, not having advice attached. So you often will also see, now this is ludicrous, but these property groups traditionally in the past that put people into those kind of assets, there's no long-term advice. So it's not uncommon to see a client with an investment property with a debt against it and cash that's accumulated in a cash account inside the SMSF. So they've got an underperforming property, they've got a loan on a property that's probably 7%, give or take, probably more.
Probably more now,
if it's an SMSF loan, and they've got cash that might be earning them 2 to 3%.
Right.
Because no one's giving them advice on what they should be doing. So you see a lot of that stuff, and it's sad, really. But back to what we were saying before, I think people are more educated now than what they were, and we're very pro SMSF. It's got to be managed properly.
It's a good point you mentioned. So people are more educated. So does that mean, are you seeing younger people come to you now? You talk about investment advice, but has that been a good change as well for you guys, that people are getting, oh, okay, maybe I should need to, as opposed to coming to you with 10 years to go and now saying, hey, I need your help to get me to retirement. You're like, well, shit, I need to unwind this and sell that.
Yeah.
If they're coming to you a bit earlier, is that a trend you're also seeing?
Yeah, for sure. And it goes back to access to information. You don't have to read far these days to work out or to see something in relation to young people and how difficult it's going to be to get into property. It's everywhere. So it's on their mind. We're obviously seeing rent vesting as being a big trend. And it's been a trend for quite some time now. But people are investing in property before they buy their owner-occupied, which I think is a great idea if you're not ready to buy your owner-occupied yet. So, rent vesting is a big thing. Obviously, there's so many government schemes out there that will help people get into property. Some are good, some are not so good. So, helping people understand what the pros and cons of each of those are.
Yeah.
But definitely young people are more aware just because of what the media is doing, I think.
Yeah. Well, we saw Queensland government just announced their 2%. And so interested to see where that goes, because obviously the phone will ring, no doubt, back at the office.
Yep.
Probably doesn't really change a lot what we do, because we're more with investors. That's all, they home occupier loans, so we don't play in that market. But
definitely good for us.
Yeah,
definitely good for us. And if anything, people just ring because they need to understand it.
That's right. They're not going to read all the asterisks, right? You can't buy high-rise apartments in certain areas, and banks won't loan you the money there.
That's right. So so we love that stuff as a business, but at the same time, it's not one size fits all. So it's important for people to understand the ramifications. And in some instances, there are no ramifications depending on the scheme, but in some there are. For some there are.
The Smart Property Show is proudly brought to you by Search Party Property, nominated by REB as Australia's best buyers agency and buyers agent for 2025. Looking for your dream family home, a prime commercial property, or a smart investment? We've got you covered. Unlike others, we don't rely on selling agents or property managers. We have boots on the ground in key investment cities across Australia. Powered by data-driven insights, we give you the edge to secure the best deals. Ready to invest smarter and grow faster? Contact Search Party Property today for a complimentary discovery call. Again, having tenure on your side, so with the rent vesting side, one thing I see a lot of, they've potentially, if they're a little bit older, let's say in their mid-30s now and probably married, maybe a kid or two on the way or have one, they've invested. They have bought an apartment somewhere.
Yep.
And so we've got an asset, great, but unfortunately the asset hasn't done anything for them because they bought a high-rise apartment or somewhere. And that's always a challenge because then they've got this asset that they can't use now to buy the next family home.
Yep.
And so we find that's, again, unwinding that opportunity cost, all those terms, and say, okay, well, let's start again. And so that, we're convinced we're going to rent vest. Good, okay, we need to get rid of that asset and let's go again, because then the broker will be able to leverage more from the bank and we'll be able to get a better asset for you for this investment now, which will generally be, and that's probably one of the things we see, just get people to think outside of their backyard. So become borderless investors.
Yep.
What do you mean I can't see my property? Do you need to see it? Oh, well, what if there's a plumbing issue? You're a plumber. No, I'm an accountant. Well, what are you going to do?
Yeah.
So people are starting like, okay, you're logical. That makes sense. I don't need to see it. So
yeah, and I think your industry's done a lot for that, in particular BAs, because you've started to go Eastern Seaboard. You've started to take clients to areas that you weren't even based in. Maybe Sydney-based business, and you're looking at properties or acquiring in Brisbane or WA. So it's become normal.
That's true. I guess people seeing case studies and people seeing podcasts and people showing things, and it's like, well, okay, well, people are doing it. It's not abnormal. And I don't need to touch or feel my property.
No, that's right. And if I think to when buyers agents first became popular, they worked in a specific area, and it was for owner-occupiers. So someone worked in a particular area and they were the experts in that area. They had all the relationships with the agents. And if you didn't have time to look for your owner-occupied home and you had the money to afford a buyer's agent, then that's what you would do. But it's since evolved into people having investment expertise like yourself and looking outside of their own backyard.
A lot of the owner-occupier buyer's agents were very much in more exclusive areas too, right? In Sydney would have been the North Shore, the eastern suburbs. And here you kind of got the Parans and the Qs and these sort of areas that need that help or can afford or don't have the time to or inclination to go and look at properties. Sometimes need to be confidential about things and pricing and things like that as well.
And access to properties that might not be on market too, and particularly in this market at the moment, in good suburbs, there's not much stock, or in Melbourne there's not, So I think, but from what I understand, there's a little bit that's off market. So understanding if there's properties out there that haven't been listed or are about to be listed, and if you've got a good job and you're earning good money, the fees are almost negligible because the time that a BA puts into trying to find you a good asset.
And keep your emotions out. But we're doing a couple at the moment, and just you can see the emotional turmoil that's putting the client through. It's a family home, and it's a big purchase, big number. And now they're seeing what is the benefit of having someone by their side who's unemotional. Obviously, I'm emotional for them. I want to win. But we also can walk away if we have to, because if we can't get the number, we just walk away.
And it's like business. You get deal fatigue. Like if you spend so long on something and don't execute, after some time, you just get fatigued and you move away from it. And we see that with clients that are pre-approved with loan applications that don't buy for 6 months because their expectations weren't in line with what they actually, where they needed to be from a purchase price point of view. They keep getting outbid or whatnot at properties, and after 6 months, they just stop because they've got fatigue. So I think a buyer's agent really combats that.
Well, it's that speed to market, right? So most people can only go out and do that on the weekend and have the kids crying in the back seat after soccer or whatever else, where you got a professional doing it 24/7.
That's right.
On your behalf. We actually get a lot of those people after they've done it. They've given it a crack. They've almost got divorced after trying to do it for 6 months. The kids have had enough. They're not going to come with them anymore. And they say, but they also don't realize the amount of money they've lost over that time. So the fee is almost doubled because they've, especially in a moving market, and most of the markets have been moving in certain areas, especially they're buying in, like you said, those white collar areas.
We try and it's difficult, but we try and say to our clients that are pre-approved, I know you've got your budget at, let's call it $1 million. Set it, if you can, push it to 1.1, because I've been doing this a long time, and what I can guarantee you is anyone who purchases an owner-occupied property, it's two things. It's never comfortable, as in they're always scared about the debt and the purchase price. And number two, they always think they overpaid. Very rarely do you get someone that says, I've got a good deal on that. So if you don't stretch yourself from the start, you'll be sitting there in 6 months' time because everyone else will stretch themselves. You'll be sitting there in 6 months' time going, geez, I should have bought that place, or I should have bought that place. So we try and talk to people up front, just based on our experience, this is what's going to happen.
Yeah.
So whatever your budget is, just go a little bit further and try and execute quick. Or you could still be sitting here in 6 months and, to your point, paying another 5 to 10% for the property.
I think that's where the advocacy comes in, right? And I think, like you talked about before, social media, buyer's agents, who knew was a buyer's agent is? And now there's all these shows, especially a lot of the American ones coming out. They are reality shows after all, but they show that buyer's agents are in the mix. America's 80%, right?
Yeah.
I mean, I know the laws changed there about how much they can charge now. I mean, American models is almost pure collusion. The buyer's agent and the selling agent can sit next to each other in office and negotiate a deal.
Really?
Yeah.
And
they split, let's say, 6%, which it was, they get 3% each.
All right. Okay. That's very different.
Yeah. Whereas at least there's some separation here in Australia. Yes, we criticise a few things around legislation and ASIC and some of the, because even in the real estate law, there's no buyer's agent license. Right? We have to get a full real estate license.
Yeah. Yeah. Yeah, that's interesting. But it obviously works if it's 80% of the market.
Yeah, so
6%.
But in Australia, I don't know if they've done any accurate numbers recently, but they're talking on 5%, sub 5% are bought with a buyer's agent. I reckon that's probably changed quite dramatically in the last few years. But you think about that, like, so people are trusting. There's some amazing. They're all great selling agents or real estate agents, we call them in Australia, but they don't work for you.
Yeah.
They work exclusively, 100%. They're getting paid by the vendor, and their pure job is to market the property and sell at the highest price.
That 5% is interesting. It's obviously delayed. It would be delayed data, but I just feel like, particularly the last 12 months, and the way that I can get a read on this is where our lead flow into the business is coming from. So we've got a mixture of real estate agents, website leads, and word of mouth, self-generated, whatever. But the spike in leads in from buyers agents has been very noticeable in the past 12 months.
Right.
And we're seeing these businesses grow as well. So
the leads coming in, but also I guess when let's say the lead didn't come from a buyer's agent, but when you talk to the client,
they're using one.
One. So you're seeing that trend.
Yeah, definitely.
And that's what I think would be much higher. But I know, when we started 17, 18, we had to spend a lot of time explaining what the hell's a buyer's agent.
Yeah. Yeah.
Why would I pay you to do that? It doesn't make sense. I don't pay the real estate agent anything.
Yeah.
Well, the guy who's trying to sell me off to plan a property, he's free. Doesn't charge me anything. In fact, he's giving me a 10 grand cash back.
Yeah.
How do you compete and try to explain that to someone?
Yeah.
What's really involved in the commissions in that cash back?
Yeah. Yeah.
You've actually paid him 40K, but you just don't see that.
Cases, yeah. So, but I think, as more and more people start to use them, as people like you do get good results for people, then they refer on, and I just can see it snowballing.
It's going to be interesting how it grows, and talk about AI the other day, and how that's going to have an effect on all industries.
Yeah,
menial tasks, even your industry, right? There's a lot of things. Your paperwork is huge, and your compliance could be replaced by a lot of these type of technologies.
It's already happening. We're using 2 specific tools now that are helping with the back end. So our capacity as a business, or our productivity as a business, just continues to go up and up, which is great. So we're kind of in this sweet spot at the moment where, of course, long term, you got to look at AI and go, well, okay, how's things going to look, and do we still have a business? That's obviously the scary part. But we're in this sweet spot in the medium term where all it's going to do is create more productivity and help us to do more. So the really confident about the medium term with AI. The long term, we've got to start to have some deep discussions about what does our business look like.
We'll see that in a lot of, think about buyer's agents. We talked a lot about data, and that's hands-on, but now we're getting software programs that we can use, which is also accessible to the public. Do they want to spend whatever I pay 10 grand a year on it? Probably not, but they can maybe buy a transaction and use it. But that human touch is still there. It's actually visiting a property and inspecting that property. It still, at the moment, can't be done by a bot.
Yeah. And it's confirming they're doing the right thing. That's how I explain it. So, and your industry would be similar. You can get access to all of the information you want pretty easily, and you might have AI come up with a solution, which it can do in our industry now. Yeah. People still want, maybe this generation and the next one, they still want confirmation that they're doing the right thing. So for us with AI, it's absolutely brilliant because where we add 90% of our value is that confirmation.
Yeah.
Where 90% of our work goes is the processing in the transaction. So if we can eliminate 90% of the work through AI and get paid to deliver 90% of the value, that's a really good story for us. And that's the environment we're in now, just at the start of it.
Yeah.
I think we've got a couple of generations before people will be happy to make decisions. But things are changing.
Well, at least you're aware of it. You're not pushing back on it.
Yeah.
You're embracing it and moving with it. And we'll see it across, every industry. Someone was talking about VAs the other day.
Yep.
All of us have VAs in our businesses. Yep. Are they relevant? Maybe through AI in the future, maybe not. If they've especially got no human contact, I think that's the big key.
Yeah.
Your business is a human business, right?
Yeah.
Trust,
yeah,
giving me advice, and also confirmation that we're doing the right thing.
Yep.
Similar with us, right? If we can keep touching our clients and talking to them,
Yep.
that can't be done by a bot.
No,
well,
it can't be.
Technically, in terms of
not
sales calls, maybe,
Yeah.
but yeah. And I've talking to it about we have a property management business as well, and even that, a lot of that automation I'm trying to do in the back end, because we still have to have that human being talking to our clients about their investment, right? That's their asset. We're managing their most important asset, their investment property. So it's very serious.
Yeah.
But a lot of that back end, getting something repaired, can be done through AI or automation.
Yeah.
But for me, it's like embrace that, get that really dialed in. So that human property manager, as we call them, is actually on the phone talking to you. Imagine you getting a call saying, hey, every 6 months, hey, Nick, I've just inspected your property. Everything's going well.
Yeah.
Blah, blah, blah. Rent's looking good. I reckon in 6 months' time, we can increase it by $40.
Yeah.
But your client's happy to stay. I've had a good chat. Anyway, good to chat. Talk to you later. And they can probably throw in a few curveballs around looking to invest again, looking mortgage broking again. So you can use that as a sales tool as well.
Yeah.
And no one expects that call. Whoever does that. I've been investing for 20 years. You have as well.
Yeah.
I don't know how many property managers have ever done that to me.
Yeah, and that's where the value's added. It's very similar to us. That's the part the client really appreciates. So, you're just really leveraging AI to make sure that you can spend more time on where the value add is. Your landlord doesn't care about how you organise a quote for a plumber to come out.
Yeah.
So if you can get rid of all that stuff and spend time where you want to spend it, it's a really good position to be in. So I think any business just has to embrace it now and be aware, but be cautious as well. Like the other problem that I can see happening is people just trying everything. So we're very cautious in, okay, well that's what's available now from a product point of view. Let's see what else is out there. Let's not change all our workflows and systems because of this new product.
Yeah.
Because there's every chance that there's going to be something better in the next couple of weeks. So I think you have to be cautious about what you implement as well and make sure that you don't just try everything.
Yeah. We're all getting calls from AI experts right now, right? To implement.
It's nonstop.
And,
it's nonstop. Like, LinkedIn's gone from, getting hammered by recruiters to now getting hammered by AI experts.
Recruiters or business coaches or life coaches.
They're still there though.
Yeah.
Yeah, it's exciting and it's it's definitely a lot different to what it was when I started.
No, I think that's the main thing is that we embrace it and challenge it and push it, and because it will definitely help our business from an administration point of view.
For sure.
Compliance, that's another matter that the authorities can look after because if a body's going to do a sales call, are they going to get away with giving advice?
Well, should
we acknowledge and say, hey, Nick, my name's Julian. I'm the automated bot, better word than bot, I'm sure, from Search Party Property, or do we just pretend I'm a normal person? That to me is the clincher that there's still no regulation around that.
Yeah, and look, it's probably why I have long-term confidence in our industry because obviously 2017, 18, we went through a Royal Commission. It's not that long ago. And it's all about the client-centric. What are you doing to make sure the client's okay? So I think as much tech as you introduce or as much AI as you introduce, there's still that compliance piece. And that stuff doesn't change quickly. For our compliance regime to change, it's a long, arduous process that I can't see happening anytime soon. So that's really what I hang my hat on as to why our industry will be, safe's the wrong word, but definitely still around for quite some time. Yeah.
Speaking of your industry, one thing, we get asked a lot of questions. It'd be good for you to sort of help our listeners clarify that in their mind. So a lot of people are always looking for the cheapest, shiniest object, which is what's the cheapest rate, right? How many times people must say to you, what's the best rate you can get me? You can't answer that question because there's a lot of different options. I can get you a better rate, but it comes with these terms and conditions, right? How do you explain and express that to someone to not just rate isn't the only important factor of building your finance plan, and not just for the one, let's say, investment property, but ongoing to building up your structure?
Yeah, that's a really good question. And it's, again, we talk about that awareness piece. So people want to know how to build 2, 3, 4 property portfolios. So I think these days it's a little bit different too, in the fact that rates are fairly similar no matter where you go. And just a little bit on rates, banks come and go with discounts. So when you're selling a rate, you're really selling, for lack of a better word, selling. But what is the discount off the standard variable? Because we are in a declining interest rate environment, and we've seen banks pass on the full 0.25 and 0.25 drops. Over time, that will change as the RBA passes more drops on or more decreases on. Banks will go out of line. Some will give 0.2, some will give 0.5. Some won't do the whole 0.25 for investors. This kind of stuff will start to happen.
We saw that back.
Correct.
Back in the last decrease.
They've got cost of funding pressures, as much as it's hard for people to believe when they see profitability banks. They do have cost of funding pressures. So I always used to talk about, what's your discount off the standard variable? Because Bank 1 might be cheapest today, but they might not be cheapest in 7 months, 8 months. Bank 2 might not be the cheapest today, but they might be the cheapest in 7 or 8 months. So if you've got a lender that you're satisfied with, you've got to look at what discount you are off that standard variable rate, because that discount is for life. Yeah. They'll chop and change as to who's got the best standard variable. So that's the first thing on rates. But we're very much talking about what are you actually trying to achieve? So if you want to buy a property, an investment property, why are you buying that? And second to that, if you want to buy 2, 3, 4 properties, what does that actually look like? So have you sat down and thought about property 2, 3, and 4 when you're buying property 1? So are you chasing capital growth? Are you chasing cash flow? Depending on whether it's a capital growth property or a cash flow property, what impact is that going to have on property 2? Property 2, what does that need to look like? So if you've got to build a portfolio of 4 properties out and you've just focused on capital growth, you're probably going to run out of serviceability as of property 2. So when clients come to us, as soon as you start to unpack goals and talk about where do you actually want to take this, what are you trying to achieve? Is it a legacy for your kids? You want to educate your kids, so you want to invest? Do you want to retire, be financially free by age 55, 10 years before the norm? When you start to unpack those questions, the interest rate chat disappears, because people see, okay, well, this is not about cost. This is about what I'm actually trying to do here personally and for my family. And sometimes the best rate isn't the best option for you. Yep. There's different products around to help you reduce debt quicker. Sometimes you need different banks to give you more options if you want to continue to grow your portfolio, because different banks assess things differently. So you want to keep your options open. So for us, we talk about the long-term plan and making sure the structure is right and making sure you're thinking 5 years, 10 years ahead. And then the interest rate will be what it will be. Yeah. But what you can almost guarantee in this market is, as long as someone's got good income, a good job, what they can get at one bank, they can get at another. So it's very rare that people come to us just simply chasing rate. Owner-occupied properties, yes. And then you had that chat around what is a good rate really. But when it comes to investment portfolios, we quickly take it away from rate. Yeah. And people really appreciate that long-term view, and they don't think about rate generally. Yeah.
Well, the difference to, talking about land tax and areas like that, because, hang on, Victoria at the moment, right? Land tax, I want to invest in Victoria because of land tax. Well, it's a small price to pay for a long-term investment goal.
And ignore the tax. Actually ignore the word land tax because it's everywhere at the moment. Just look at the numbers. So forget about land tax, forget about landlord's insurance. Look at all the numbers and see if that property makes sense versus somewhere maybe in New South Wales or WA. Whatever got you to that number, work with the number that actually fits into your strategy, capital growth and cash flow wise, and it doesn't matter what makes the number up. If it's land tax, there's no guarantee that New South Wales or Queensland or WA aren't going to follow suit.
Exactly right.
So it's, I'm
people
not
do get stuck. That's why we break it down and use the cash flow analysis, right? And say, well, you can buy a property in, I think it's Brisbane for 600, buy one in Melbourne for 600.
Yeah.
It's a $2,000 difference.
Yeah.
So if you're going to earn double-digit growth in Melbourne, and Brisbane's probably coming off its sort of high growth phase, it's irrelevant, right? That $2,000. So it's going back to your point about rates, interest rates,
and tax is the same. And I think we've evolved a lot. But we talk, going back to the property groups that would sell new properties or off the plan properties, it was all about negative gearing.
Reduce your taxable incomes.
And that shouldn't be the reason you buy property.
It's a byproduct, right, off your investment strategy or plan.
100%. You always buy the property that makes sense from an asset point of view. What's the best asset?
Yeah.
If you can manage the cash flow on that, then you do that. If you can't, then you need to find another solution. But people going into property because they need to leverage negative gearing makes no sense at all. Yeah. And I say this line to clients all the time, but would you rather have the dollar, or would you rather spend the dollar and get 30% of it back? And people go, so I'm 70 cents worse off. I go, pretty much. Yeah. So you might as well keep the dollar. So it's the whole negative gearing thing for me. Whilst it's great and it's a good way to get some tax back if it's the right asset. Yeah. Seeing that drive people's decisions historically for quite some time is crazy to me. People are happy to spend money to get a little bit back, but that is changing. People are understanding that they need properties that provide good cash flow and good capital growth, because if they don't, then they can't do property 2 and 3 and 4.
And that comes back to experience, right? And we've seen different market fluctuations. Anyone who's invested in the last 10 years, it's been party time. Yeah. And so that's what they're expecting. They're, hang on, why can't I get 20% growth year on year? Well, doesn't really happen. That's 3 times the average. Yeah. What is it? 40-year forecast, 40 years of property, that's 6% average. Yeah. Yeah. So if you're getting 20, you're killing it, but it doesn't happen every year.
No, it doesn't. And that's a really interesting point that you say, because it's going, and you would have this conversation more than I do, but are those expectations going to still be there, particularly when you've seen areas like Brisbane, where I know you've been very active in Brisbane and WA doing what they're doing. It's not normal. So will it continue? Will people have expectations that that's what they should be receiving from a capital growth point of view? We'll see. But that's where people like you come in to educate, I guess.
Try our best.
Yeah.
Well, Nick, thanks so much. It's
no worries.
Amazing wealth of knowledge you've spread and shared with our listeners. And obviously we'll put all your contact details in our notes, because I'm sure a lot of people want to continue on the conversation.
No worries.
Thanks again for your time.
Thanks for having me. Cheers.
If you enjoyed the show, it'd mean a lot if you could take a moment to rate and review it on your favourite podcast platform. It really helps us reach more listeners like you. And don't forget to hit subscribe so you never miss an episode. Thanks again, and I'll catch you next time.